Welcome to this explainer. Today, we're going to entirely demystify the banking system by sketching out the invisible levers that literally control our economy. I want you to picture a blank whiteboard in front of you. Over the next few minutes, we're going to draw a massive, interconnected map of exactly how money works, visualizing it as water flowing through a really complex system of pipes, engines, and selective sluice gates. It's a completely fascinating mechanical system, and honestly, once you see how it's drawn out, you'll never look at your local bank the same way again.
So here's our roadmap for this explainer. First, we'll look at the business of banking. Second, how banks actually create money. Third, we enter the central bank. Fourth, controlling the money supply. And finally, number 5, those incredibly targeted qualitative tools used for directing the flow.
All right, part 1, the business of banking. We have to start with the absolute primary engine of our economy, commercial banks. Now, their main job is mobilizing household savings. You might think a commercial bank is just, a glorified vault to keep your cash safe. But they don't just hold on to it. Because they take deposits and use them for lending, they possess a completely unique superpower that regular financial institutions, like a mutual fund or a post office, just don't have. Commercial banks can actually create and destroy money through their lending activities. Let me show you exactly how that works.
Which brings us right to part 2, how banks create money.
Let's look at how this superpower builds into an incredible chain reaction known as the credit multiplier process. To sketch this out on our whiteboard, we need to split deposits into 2 distinct buckets. On the left, we have primary deposits. This is pretty simple. It's just a customer walking in and depositing physical cash. But on the right, we have derivative deposits. And guys, this is where the magic happens. When banks advance loans, they aren't handing over a briefcase full of physical cash. They actively create derivative deposits completely out of thin air, simply by opening a current account in the borrower's name and typing a number into a computer. This action literally increases the money supply in the economy.
Imagine drawing this flow out. Step 1, a customer deposits a fresh 1,000 rupees. Now, the bank knows for a fact that not everyone is going to ask for their money back on the exact same day, so they are legally required to keep just a fraction of it safe in the vault. Step 2, they keep a 20% cash reserve. That's 200 rupees. This leaves them with an excess of 800 rupees. So in step 3, they pump that 800 rupees right back out into the economy as a fresh loan.
And this brilliantly illustrates what happens next in the chain. That 800 rupee loan gets spent at a shop somewhere and the shopkeeper deposits it into their bank. Let's say Canara Bank. Canara Bank then keeps 20% of that 800 rupees, which is 160 rupees, and loans out the remaining 640 rupees. This cycle just repeats and repeats across different banks in the system. If you look at the total at the bottom, that initial 1,000 rupee deposit has actually multiplied through the banking system to generate 5,000 rupees of newly created bank deposits.
But looking at this multiplying loop on our sketch, an obvious question pops up, right? If banks can just keep multiplying credit like this, what stops them from printing infinite money? What exactly prevents the entire economy from drowning in a massive, overheated speculative bubble?
Well, that brings us to section 3, enter the central bank.
Meet the conductor of our economic orchestra, the central bank, which was established here in India back in 1935 as the Reserve Bank of India. They are the apex institution holding the reins. If we draw a line down our board to compare them to commercial banks, the differences are instantly stark. Commercial banks are profit-driven. They deal directly with you and me, and they have thousands of branches. The central bank, however, it has absolutely zero profit motive. It is completely welfare-driven. It acts as the banker to the government, holds the absolute monopoly on issuing physical currency notes, and serves as the ultimate regulator ensuring the proper functioning and stability of the whole system.
Moving on to section 4, controlling the money supply.
To prevent pure economic chaos, the central bank acts as the supreme controller of credit. On our sketch, I want you to think of these quantitative methods as the main, giant water valve for the entire country. They control the absolute volume and cost of money flowing into the economy. If they tweak the repo rate or the cash reserve ratio, they are essentially opening the main valve to flood the economy with credit or tightening it to restrict the flow entirely, without any discrimination whatsoever as to where that water actually goes.
And that leads us to our final section, part 5, qualitative tools for directing that flow.
See, unlike traditional volume tools, qualitative or selective credit control methods don't focus on the absolute volume of money. You don't want to shut off the water to the whole country just because one specific crop is getting flooded, right? Instead, these tools regulate the specific use, direction, and flow of bank credit across distinct sectors. Think of them as selective sluice gates. They actively open channels to water socially useful purposes while firmly blocking off gates marked for speculative or unproductive uses. Let's break down exactly how these targeted tools work.
First up is the regulation of consumer credit. Imagine a purchase sheet for a brand new car drawn out on our board. This tool controls hire purchase financial credit for expensive items like vehicles or big appliances. If the central bank sees people taking on way too much debt, they can contract credit usage instantly by forcing a higher mandatory cash down payment up front and significantly shortening the maximum allowed monthly repayment window. It cools down that specific sector immediately.
Next is the regulation of margin requirements. Think of this as the required safety buffer. It's essentially the difference between a collateral security's actual valuation and the maximum loan a bank is legally advanced against it.
So the crucial point here is how fast this tool drains speculation. Let's say you pledge a bank security worth 1 lakh rupees. With a 25% margin, the bank holds back 25,000 rupees as a buffer and loans you 75,000 rupees. But if the central bank bumps that margin to 30% to stop market speculation, lending instantly drops to 70,000 rupees for that exact same asset. They've successfully tightened the flow of credit to that specific market without touching interest rates for anyone else.
Our whiteboard sketch is rapidly filling up now with the remaining tools: rationing ceiling gates, a gavel representing directives, a formal boardroom handshake, and strategic media outlooks. Let's look at these last 4 tools in action. Third on our list is credit rationing. By enforcing this, the Apex Bank literally drops a hard cap on the sluice gates. They fix rigid ceilings on the maximum loans a commercial bank can award, or they set a maximum loan-to-deposit ratio limit. If a bank is overexpanding, this forces a complete freeze on their lending capacity past a certain point. Then we have the classic carrot and stick approach. For the stick, we have direct action. The central bank can issue strict operational directives, impose harsh penalties, refuse loan advances, or even freeze discounting facilities for any erring bank that violates policy frameworks. But for the carrot, we have moral suasion. This is the method of informal advice, suggestion, and psychological influence. The Apex Bank basically brings banking executives to the table, morally persuading them to voluntarily restrict credit extensions for unhealthy speculative bubbles.
Finally, tool number 6 is publicity. The central bank actively shapes the narrative by systematically publishing clear, verified statistical data and banking outlooks via news and media. This ensures that everyone understands the monetary realities, which aligns commercial choices and actively guides public opinion.
So stepping back and looking at our finished whiteboard sketch, these 6 targeted tools, consumer credit adjustments, margin requirements, credit rationing caps, direct action penalties, moral suasion guidance, and strategic media publicity, they prove that the central bank isn't just blindly pumping money into the economy, it is intricately directing the flow of water to keep the entire economic engine humming safely.
It's genuinely fascinating to realize how interconnected this all is, isn't it? Commercial banks absolutely have the superpower to create money, but their hands are constantly being guided. So next time you apply for a car loan or a mortgage and you look at those down payment requirements, ask yourself, is it just your local bank manager making up the rules, or are you actually feeling the unseen steady hand of the central bank directing the flow of the entire economy? Thank you so much for joining me for this explainer. I hope this sketch helped you see the invisible levers operating all around us.